Hi, this is Steve Landrosik. Today we're going to talk about sectors and gold. This short video is part of an educational series designed to help investors. You can find this video and others like it on our website at planipg.com. Go to resources and look for videos. I recommend that you watch them in order. So, just to recap, previously we spoke about mutual funds and risk associated with stocks versus bonds, or risk tolerance as we call it. And then we talked about what is a mutual fund and what's a stock and a bond mutual fund. We were able to determine at least that the more stocks that you have, the more aggressive that you are, the more bonds that you have, the more conservative you are. Generally speaking, right? There's a little bit more nuance to that. And as I said many times before, I think investing is a full contact sport, so get with your advisor. If you don't have one, you can call us at 772-233-4315. We'd love to help you. So back to sectors, and why do I tie this into risk? Well, think about this. We have asset classes, and we spoke about that. Stocks, bonds. Again, we'll talk about this in the framework of mutual funds, right? And then we talked about blending them for risk and so forth. But what we didn't talk about is what sectors are inside of those mutual funds. Steve, what do you mean sectors? Well, let's just take an index fund, the S&P 500, for instance. The S&P 500 is made up of 11 sectors, and I have them around here somewhere. I'll go through them quickly. There's 11 of them. Basic materials, communication services, consumer cyclical, consumer defense, energy, financial services, healthcare, industrials, real estate, technology, and utilities. Did you count? Was it 11? I think it was. So if you buy that index fund, it has all of these in it. It has them in different, what we call weightings, right? So financials may make up 15%, information technology may make up 30%, energy may make up 5%, right? Who makes that decision? Well, it's the mutual fund manager, right? And you can make that decision too if you buy funds or investments that are specific to a particular sector. Microsoft being technology is an example. Not to say that we should buy it or not. It's a good company though. But the more details that you go into in terms of investing, the more opportunities there are, and then also the more risk that comes along with it. So what I mean by that is, when you have a stock mutual fund with all 11 of these sectors inside of it, and on top of that, you say, I'm going to go buy an energy fund or a bunch of stocks that are investing in energy. What you're essentially saying is that the mutual funds that you have do not have enough of that. So you're going to add to them. Because whether you know it or not, you have energy. You probably have Microsoft. You have all of these sectors inside of your mutual fund. So if you buy specific sectors, what you're saying is, Mr. Mutual Fund Manager, I think you should have more. Well, if you're right, you get rewarded. And if you're wrong, well, you know what happens there, right? So as I said, the further down you go, the more risk and the more opportunity. What do I mean by that? Let's take energy, for instance, okay? If you want to invest in the energy sector, you could buy an S&P index fund that is specific to that sector. They have sector funds, right? But let's say you want to drill down even deeper. Remember, the more detail you go, the more risk, the more opportunity. And you say, I want to buy XYZ company that is involved with alternative energy, or XYZ company that is involved in more traditional petroleum-based energies and so forth. If you're right, again, you get rewarded. If you're wrong, you don't, right? So the further down you go, think about stock and bond mutual funds, sectors, the stocks that make up the sectors. And when you buy a stock, you're also saying to the mutual fund manager, I think you probably have this stock, but you should have a little bit more. So second guessing these mutual fund managers, I'm not saying it's taboo, but understand, if you have just a blended large cap or small cap mutual fund, unless it specifically talks about a sector, it's usually going to be blended with all of those, okay? I said I'd get around to gold. One of the most misunderstood investments that are out there. Now, in this series, the consistent theme has been, what is the risk associated with it? What is the reward associated with it? Right? We don't have to take any risk if we put all of our money in cash, right? That's risk-free, right? Wrong. You have what they call purchasing power risk. The risk that if you put your money someplace and it doesn't grow, when you go to spend it 10 years from now, it'll buy less stuff. So there's always some risk associated with it, right? So gold. Many people think it's a safe investment. I'd argue that none of these investments can be called safe. It's just a matter of what kind of risk. But gold has its own unique risk. You can buy a mutual fund or an ETF that specializes in just gold. And you could get in and you can get out very easily because they trade on the New York Stock Exchange. And there are just people that'll say to me, but Steve, I want to hold the physical gold. I say, what for? What is it going to do for you? I'm not saying don't do that, but I think a lot of people don't understand the risk because you have two different kinds of risk when you invest in physical gold. You have the risk that gold may go down, right? Right now it seems to be doing pretty good, but for those people that are, say, 50 years old, we remember when gold shot up 80, 81, and then it went down, and it didn't reach those levels for maybe 20 some odd years. So anything that does that, I'd argue, is not safe, right? But the physical bar of gold that people want to hold, there's something called a contra-party risk. Oh, goodness, Steve, what is that? Contra-party risk is the risk that somebody will not take it off your hands, or the risk that somebody will take it off your hands, but at a substantial discount. So let's say gold is trading at $2,000 an ounce. You bought a bar and it was trading at $1,000 an ounce, right? But you probably paid about $1,100, $1,200 for it because the person selling it has to make a little profit, right? Now you go to sell it. You read in the paper it's worth $2,000, and you go someplace that's a gold exchange place and you say, hey, here's an ounce of gold. Give me $2,000. And they say, well, we'll give you $1,800. We'll give you $1,500. We're not buying gold right now, and you have to shop around and try to find somebody to buy this gold from you. But if you buy gold on the New York Stock Exchange through an exchange-traded fund, there's always somebody to buy it from you, right? So I'm not certain what the reward or the benefit of having a physical piece of gold is. Maybe someone can email me or call me and kind of let me know. But I haven't really found one. Again, it's not a recommendation not to buy gold, but it's important that you understand the risk associated and the rewards that you get. In the case of gold, I think the rewards that I get will be the same, if not greater, if gold goes up and I own an ETF that tracks the price of gold, because I'll get out quicker. So I'd argue that in both the up and the downside, I'd rather have liquidity. Liquidity means you don't have that contra-party risk. That guy smoking a cigar on the other side of the counter and saying, son, I'll give you $1,500 for it, right? So we want to avoid that. With that, I will say to you that if you have any questions about this topic and any other topic, you can call us at 772-233-4315. It's Investment Planning Group. Email me at info@planipg.com. Thank you very much for watching.